Welcome back, everyone. Okay, today we are going on a hunt for free money. And yeah, I know, that sounds totally like clickbait, but stick with me because we're actually digging into this incredibly dense, fascinating academic study by financial researchers Kapil Gupta and Dr. Balinder Singh. They took tick-by-tick data from the National Stock Exchange of India to uncover these hidden market mechanics. And honestly, what they found, it reads way less like a dry financial paper and a lot more like a thrilling detective story about where the market's perfect math completely breaks down and where these lucrative glitches are just hiding in plain sight. Okay, let's dive right into this with a question that kind of challenges the very foundation of market pricing. If two markets are selling the exact same asset, shouldn't the price be totally identical? I mean, think about it. A share of a company is a share of a company, right? No matter which window you buy it from. If it's cheaper at one window, well, everyone's going to rush there, which drives the price up until the two windows match again. This is literally the bedrock of modern finance. In economics, this baseline expectation is actually called the law of one price. It basically states that in an efficient, frictionless market, identical goods absolutely must sell for the exact same price. And if they don't, well, arbitrageurs, who are kind of like the market's natural scavengers, will instantly swoop in. They'll buy the cheaper asset, sell the more expensive one, pocket the risk-free difference, and force those prices right back into alignment. It's a really beautiful, elegant theory. But in this explainer, we're going to see how the real world, specifically the Indian equity market, actually operates. Which brings us to Chapter 1, the price discovery race, cash versus futures. So to really understand this mystery, we have to look at this constant competition going on between two main markets to discover the true price of an asset. First up, we've got the cash market. This is where you trade the underlying asset right now, in the present. You buy the stock, you own the stock today. Simple. Then we have the futures market. Here, you aren't trading the stock itself. You're trading contracts that lock in a price for a specific date in the future. You're essentially placing a bet on where the present will be, say, weeks or months from now. Now, these two markets are intimately tied together, but as you'll see, they definitely do not always move at the exact same speed. Moving on to Chapter 2, the long-run connection, the invisible rubber band. Let's look at the long-term relationship between these two markets first, because, eventually, that mathematical theory we talked about earlier, it does actually hold up. The researchers found a strong and stable long-run relationship between Indian equity futures and cash markets. In econometrics, they call this co-integration. Just think of it like an invisible rubber band connecting the cash market and the futures market. As new information hits the world, like a big earnings report, some political event, a change in interest rates, one market might jump ahead. The rubber band stretches. But over the long run, the tension always wins out. Those arbitrageurs do their jobs, the gap closes, and that rubber band snaps the two markets back into equilibrium. So by the time a futures contract reaches its expiration date, the price of the future and the price of the cash asset absolutely must converge.
All right, Chapter 3, Spotting Short-Term Arbitrage, the glitch in the matrix.
Now, what's really interesting about this is what happens while that rubber band is stretched. This is where the perfect theory completely breaks down. The invisible rubber band gets incredibly tense, and those magical arbitrage opportunities suddenly just appear out of nowhere. When breaking news hits at time zero, the futures market instantly reacts and absorbs that new info. Meanwhile, the cash market just sits there, price totally unchanged, basically asleep at the wheel. It's only later, at time plus delay, that the cash market finally wakes up and catches up to the price that was already established by the futures market. The researchers proved that the Indian equity market has a massive information spillover effect, but in the short run, it is entirely a one-way street. So you're probably wondering, exactly how long is that delay? 5 to 55 minutes. That is the exact time window that arbitrageurs have to act. For a minimum of 5 minutes, and sometimes stretching up to nearly an hour, the futures market is literally living in the future, while the cash market is just stuck in the past. If you can see the futures price jump, you know with near absolute certainty where the cash market is heading over the next hour. You basically have a 5 to 55 minute head start to position your trades and capture that free money before the rubber band snaps back. So, the crucial point here is exactly what Gupta and Singh concluded in their study. The Indian equity futures market absolutely dominates the information transmission process. It is the undisputed leader in price discovery. And the cash market? Well, it's really just a satellite, kind of orbiting around the futures market and waiting for instructions on where to go next.
Let's move to Chapter 4 and see how this builds. The expiration day twist, a unique phenomenon.
So we know the markets converge at the end of a contract cycle, right? Well, buckle up, because this is where we hit the most surprising, totally rule-breaking finding of the entire study. If you read traditional Western financial models, studies based on US or European markets, they all say the exact same thing. As the contract expiration date approaches, uncertainty vanishes. Therefore, mispricings and arbitrage opportunities drop to zero. The rubber band is relaxed. But it turns out the researchers discovered that in India, the market completely defies these traditional models. In the Indian equity market, mispricings significantly increase as the expiration date approaches. There's no way around it. The closer you get to the end of the contract, the wilder the gap between the two markets becomes. And this brilliantly illustrates what's going on. In India, futures contracts expire on the last Thursday of the month, which means the new contract cycle always kicks off on a Friday. On Fridays, the market experiences the highest volume of mispricing. It is just the Wild West out there. The market is trying to digest an entire month's worth of future uncertainty, and that creates massive arbitrage gaps. But by the time you get to the following Wednesday, the day right before expiration, the mispricing drops incredibly low. All those anomalies just fade away.
Which takes us to Chapter 5. Why the gap persists, finding the culprits.
So this brings us to the final phase of our detective story. We know these gaps exist, and we know they run completely contrary to Western models. But why? Uncovering exactly why these lucrative glitches happen in the first place requires us to look away from the math for a second and actually look at the humans running the system. The researchers identified a really clear list of real-world frictions. This isn't a math error, guys. It's a structural one. We're looking at regulatory restrictions set by SEBI, the Securities and Exchange Board of India. They impose strict position limits on institutional traders. And because of these hard caps, big traders have a really strong preference for early liquidation, basically unwinding their trades or rolling them over to the next month early, rather than holding them all the way to the exact expiration day. Add in a general lack of overall market competitiveness with a massive percentage of trading heavily concentrated in just one exchange, and you've got the perfect recipe for market inefficiency. Let's ground this theory in some real-world mechanics and look exactly step by step at how a regulatory ceiling actually forces big players to leave free money on the table. So, step 1, institutional traders hit their hard regulatory position limits. They literally aren't allowed to trade more of that asset. Step 2, because their hands are tied, they're forced to unwind or roll over their positions before the contract actually matures, just to free up capital. And then step 3, this massive, premature, forced action hits the market abruptly. It completely warps the price, stretches that invisible rubber band to its absolute limit, and creates sudden, highly profitable mispricing gaps for any arbitrageurs who are quick enough to spot them. The researchers impartially sum it up perfectly in the study. Regulatory restriction on the participation of institutional traders may be a significant factor leading to negative association between mispricings and days to expiry. It is honestly fascinating. Rules designed to manage risk and maintain market stability are the exact same mechanisms that inadvertently create these reliable, exploitable gaps. By capping the big players, the rules essentially put a speed limit on market efficiency, allowing those 5 to 55-minute delays to persist. Which brings us to the ultimate takeaway of this explainer. The data clearly proves that the Indian futures market is driving the car, and the cash market is just riding in the passenger seat, up to 55 minutes behind. So if you're an everyday investor simply buying stocks in the cash market based on breaking news, you really have to ask yourself, if the futures market is already living 55 minutes in the future, are you trading in the past? It's a provocative thought, for sure, and one that completely shifts how you view those flashing numbers on your trading screen. Thanks for joining me on this deep dive, and keep questioning what you see out there in the markets.